Hello, everybody, and welcome to this week's edition of SelfWealth Live, the technical analysis edition. We've gone longer than what we have previously in the last 5 attempts. So I'm assuming everything is going okay now. Everyone can hear me. Chuck in a bull a bull message in the screen on the live chat if you can. Otherwise, I'll keep the support on the line just in case. But it looks like we're going live. I can see on my phone as well. It looks like we haven't got any issues here. So, hello, Jason. How are you after 15 minutes of mucking around with good old software?
Hey Rog, that was all a new experience for both of us. But look, good to finally make it here live with you and our viewers. Thanks for patiently waiting for us, and yeah, lots to talk about. So yeah, let's move into it.
All right. So yeah, just be wary if it happens again. We will try and log back in, again. And thanks for your patience today. We're gonna have a full show today. Obviously, it might go a little bit over time because of what's happened now, but we'll still try and keep it to the hour. Obviously, thanks for your patience on the other side of the line once again. Thanks, guys. As you know, what we're going to do today is go through the Australian markets from a price and technical analysis position, US markets and Hong Kong markets, and China, as we do every week, along with your tickers. So start putting in your tickers, one from each person. And if we've got time, we can always double back as well, right? So, okay, Jace, let's not muck around. Let's get into that disclaimer, please, while I go and chat to the support people and say, look, for now, everything's okay. Thanks, Jace.
Okay, so just a reminder that everything we do today is general commentary only, no personal advice. And I'll just quickly put up the disclaimer that we do each week. And this just goes through that. I'm not part of SelfWealth site. My business is Motion Trader. You'll see my details up the top, licensing, all of that. And then beneath there, you'll see the SelfWealth disclaimer, general commentary, licensing. All of that is in that slide.
Okay, thank you. Fantastic. All right. So obviously, we all know what's happening right now. The end of last week, it was pretty. Obviously broke the previous lows that we were talking about on Tuesday last week, Jace. We had a bit of hope yesterday, but it looks like it's starting to turn again. What's those Aussie markets doing in your mind right now,
Yeah.
Jace?
So let's go over to our charts and check all this out. So starting with the ASX 200. So it's now been 3 weeks of persistent selling from the February high, and prices have been down a touch over 10% in total. So that makes it one of the quickest reversals ever. Last week we discussed the likelihood of a test of the November low, and that of course happened on Thursday, and then we got follow through selling into yesterday. I know this is a particularly difficult time for probably most people. Those 3 to 5% pullbacks we often experience in a bull market, they're reasonably straightforward to manage. And you just look over here, like to a previous bull market, where you can see you got plenty of these 3 to 5% declines along the way. Prices come back to the moving average, maybe over several weeks or maybe over a couple of months, and then they regain momentum and everything continues on. Doesn't cause too much emotional strain. Sharp moves like we're getting now, well, these are very different. It's really that day-to-day of selling, and that's really what it's been, 3 weeks of practically day-to-day selling, and that takes an emotional toll. And I'm sure for a lot of people, it feels like it'd be easier just to sell and be done with it. But I do know that these periods, they do pass. We've seen them before. They've come and they've gone. The world's moved on. They pass, and the daily losses, they do stop. And I think it comes down to that trading plan. This is what the trading plan is all about. It's not just about like finding ideas and trying to make money. It's also, the trading plan's also there to help us get through the difficult times and help us stay in the game. And I think a lot of people are probably finding it quite stressful to stay in the game at this point. Prices have snapped back today. Yes, enlarge this a bit. We can see the low from yesterday had a snap back overnight. Prices have settled back down a bit now, but we've had that initial snapback. It may still not be the final low, but this sort of volatility that we're seeing now, it often occurs around lasting lows. Could be another retest. But we often get this sort of like snapback and falls and stuff as lows are trying to form. Another thing to observe is that a fast move from above the moving averages to below. So that's what we've got. We've got a fast move from above to below. And this typically happens when there's a rapid adjustment in investor thinking, and often due to some sort of surprise. And of course, we've had plenty on the surprise front in recent times. And the thing with these rapid adjustments is they often go too far and then snap back in the opposite direction. Maybe we're getting a taste of that snapback now. And I'll show you an example. I'll show you an example from 2022 of this exact sort of situation. And it's right in here. It's at the very start of 2022. I went through this in my strategy session on Friday. I think it's worth going through it again for those who didn't see it. Now, this is really interesting. And like, does anyone remember like what happened? What happened during this period? Why did the market have this big sell-off? And of course, almost nobody's going to remember. These things, they seem like a big deal at the time, but then when the market recovers, everyone forgets about how scary it felt at the time, and the reasons are forgotten. But look, this was at the time, this was a 12% decline. It was a big deal, bigger than what we've seen so far in the current sell-off. So what was happening back here in January 2022? Well, listen to this. It was inflation. It was rising interest rates. It was the Russia-Ukraine war and fears of a recession. So it sounds like a pretty familiar script, I would say. So stocks sold off rapidly as investors quickly adjusted for the worst. But after this scary 12% decline, plenty of awful headlines about worse was still to come, prices snapped back snapped back towards the moving averages. Now, it didn't lead to a lasting new bull market. Prices continued up for several months and then came down again. But that's not the point. The point is that these rapid adjustments from above moving averages to below moving averages, they often lead to these rebounds. And then the rebounds can help identify what could come next. So I don't think this is a time, just coming back to current day, I don't think this is a time to move to maximum pessimism. I think it's a time to continue following a good plan and act systematically, not emotionally. And of course, that doesn't, just because we have a plan and we can try and keep emotion out, it doesn't make it easy. It's still hard, but acting systematically, I think, is our best move going forward. As it stands, this is a volatile sell-off from above moving averages to below. It's not necessarily the start of a long-lasting bear market. I don't think it's a case of sell everything, but I don't want to keep holding stocks that are selling off without a planned exit level. On that point, I've been selling stocks this week and last week and the week before that have come back to their exit levels, and I'll continue doing that. But again, my selling is planned. It's not emotional. It's not based on the market's going to crash and quickly spiral away. It could do that, but there's a plan in place should it continue to unwind. I think the possibility for a strong rebound exists once the panic subsides, but I'll continue to de-risk as necessary.
Okay. Thanks, Jace. Actually, it probably leads on to that next question. I'm gonna, because you might not have it in front of you, but there was a whole bunch of a few questions from the previous chat when we were trying to start the show originally. So I'm actually I've got it on my phone, and I'm gonna start with some questions on that, Jace. Actually, it probably relates to what we're talking about now. So this one's from Rob, so effectively what you're saying is what we want to see now. His question is, after a strong market fall, what would be the sign for you that things are stabilizing and we are ready to buy, and a specific chart pattern, higher low or something else? But what you were saying is we want to sort of see a fast snapback. Am I right? Or
a snapback with follow through. It's like we saw down in April. We had just enlarging this a bit. Like back in April, there was a we had a reversal day where prices opened on their lows and then they rallied strongly, closed near their highs, and then we had two more days of strong buying, and so there was signs follow through buying was coming. It was still too early to say, okay, this is now turning higher with great confidence. It was still an unstable situation, but it was a sign that the worst may have passed. At the moment, we don't have that. We've got one snapback, which is currently experiencing some selling. So we just need to continue to see how it develops. Or is it like what we saw back in November, where you get a couple of days of follow through, then some sideways price action, and then a push higher from there? There's all sorts of ways the price action can come out. We don't get a roadmap about how it's going to look. What I wouldn't want to see would be prices just stalling, and you get a shallow rebound that doesn't really go anywhere, and then that opens the window for further selling at some time later. But we don't know. We don't have that price action to go off yet. It's like, is the snapback aggressively bought, and is there follow through buying? Follow through buying is the key, or is it a shallow rally that can't get traction, which then is a real red flag for warning. I think it's, as I was saying, for me, it's about following my plan. I've been continually de-risking for like 3 weeks now. It's like I've still had a significant pullback or drawdown in my portfolio. I think my drawdown is currently around 13% thereabouts from the high. So that's a significant pullback. But when I look at the sort of drawdowns I've experienced over the last 11 years of running my motion trader portfolio, so I've got several portfolios. The motion trader portfolio is based around the motion trader service. I've had a couple of other 10 to 15% pullbacks. The COVID pullback was in the vicinity of a bit over 20%. The 2022 bear market was got to close to 20%. So yeah, this is up there. It's certainly up there in terms of speed, but it's what happens in the stock market. We do get these unpleasant pullbacks. They're almost the only people who enjoy them are people who like being bearish all the time and short selling, and even they probably find them hard because the snapbacks can be quite so aggressive. But it's watching the price action at the moment, and I don't think it's time to start buying. I think it's time to continuing to de-risk based on a plan, but not just rushing out and saying, okay, I've had enough, get me out, sell everything. That tends to happen around market lows where people just capitulate and just throw it all onto the market and say, I don't want to know anymore. They often look back 1, 2, 3 months later on and go, yeah, I kind of sold around the lows.
Yeah, well, that's exactly what we were always talking about, having a plan. And as per my plan, I've certainly sold off ones hitting their stop losses, whether they're trailing stop losses or whether they're they're underwater in the black now, right? But or in the red, sorry. But then let's just quickly answer this one from Roberto Jace. When an ATR based stop loss is reached, do you sell immediately or do you wait until the close of the trade? If still at stop loss, or sell the next day?
It varies. It varies on the situation. So I've got some live stop losses in the market at the moment where the ATR stops are. So should they trigger, they'll just be sold. In less volatile times, I'll usually just see my exits at the end of the day, like what stocks have triggered an exit, and then sell it the next day or soon after. But in these times where things are more volatile, I'm more across like when it's actually happening. I may sell at the time if it looks like it's just in the throes of a panic sell-off. I may even hold back and go, look, I'm just not just going to go throw it on whatever bid happens to be there at whatever price. Sometimes I'll hold off and get it on a rebound. The risk of doing that is I don't get a rebound. I've got to ultimately sell it at a lower price. But these are unusual times, and probably not the standard my standard procedure for selling, which would normally be I see what's hit the exits through the day, sell the next day or soon after.
Yeah, when you're trying to sell one that's you're hoping that might have a bit of a rebound to get a better price. I mean, I'm certainly having to deal with this at the moment. I'm trying to stick to the rules as best as possible, obviously, and just selling. But some of the harder ones to sell are the ones that you've made multi 100% gains on, and now they're coming close to their trailing ATR stop. Jason, what's your are you cutting them, or they're the ones you sort of second guess a little bit more?
No, I'm probably more prone to cut the ones sooner which are up, several 100%, and they come back. So I don't want to see a couple of 100% become a 20 percenter because I just keep holding, waiting for a rebound.
Yeah.
So that's the worst thing I can do with my portfolio. Having a great stock and giving me almost the entire gain back. Uh, Liquidity is a factor. Like if I go to sell and there's just no reasonable liquidity there, or if it's going to cost a few cents to sell it out at a few different levels to pick up enough liquidity, well then sometimes I've got to just wait. Sometimes I put an offer in, and like in a rebound like today, putting an offer above the market can be a good way to lighten a position or exit a position, because someone will just come through and hopefully take the whole parcel.
Mhm.
Times like this, it's just difficult. Exits can be messy. There can be slippage. Slippage is when you don't get the price you wanted. It happened during COVID. It happened during the during April last year in that really sharp part. Like you don't get nice fills all the time when your exits, but you just do the best you can to shut down risk when you can, without trying to get caught into a panic situation.
Yeah. All right. Fantastic. Well, let's move on to the US market. And actually, there's a question based on it, and you can base your analysis around a bit of this question if you want. The DJI and SPX both appear to be forming 2/3 of a head and shoulders pattern. Any thoughts? And that's from Haz.
Right. Okay. So just look. Yeah, mate. I guess Haz is looking at that being the shoulder and that being a head, and they maybe we've got to get a bounce, and that could give another shoulder. So you go, things maybe prices rebound a bit, and then they start to come back, and then he'd be saying, okay, there would be there's the shoulder, the head, the shoulder, and then you draw what we call the neckline across there, and then the theory is you get the break below it, and then prices will, you do a measured move from the top of the head to the baseline, so it gives a target down around 41,000 maybe. Yeah, maybe, but it's not. It hasn't constructed yet. I don't. Head and shoulders is not one of my favourite patterns. It's like I prefer to look at the structure, rather than a head and shoulders pattern. But it would give the similar sort of thing. So if there was a shallow sort of bounce in the Dow over several weeks, and then the moving averages start coming down, someone will talk about the head and shoulders. I'll talk about how we've got a decline and we've got a shallow bounce back to declining moving averages. So it's coming up with a similar sort of interpretation that it's a vulnerable situation. Um, and that's probably that's what I'm looking for. Do we get a shallow bounce back towards moving averages, which then breaks down? Uh, but yeah, look, for those who like their patterns, that's something to look out for. Yeah, look, I guess that would be the shoulder, that would be the head. Do we get a bounce? That could be a shoulder. That could be part of a larger topping formation as well. And then that could be, we're looking like a few months, at least probably a couple of months out, if like a larger topping formation was to occur. But look, that's the sort of price action we'll continue to assess as time goes on. Last week I spoke about how the S&P 500 appeared to be close to losing its footing, and the reason for that is like we had this developing series of lower lows, and and of course lower highs to go along with that. And on last Thursday, well, we got the breakdown. The S&P did lose that footing, and that took prices below these March lows. You can see these couple of March lows. That was a bit of a key point we've been watching, and that was the breakdown from there. Prices have rebounded overnight, so we got that bounce off yesterday's low. But it doesn't change the fact that this is still a fragile situation, and I think risk does remain high. Um, there's still a series of lower lows in place. That hasn't changed. In fact, now got another low in the series, and the moving averages continue to roll over. Also, notice that Monday's close. Let me just expand this a bit. So, look at Monday's price action. We've got an open, we've got a strong rally, and then look where prices closed. Prices closed right down near the bottom of the day's range. So that's a weak close after a strong rally. I don't think this is over yet, and a retest of Monday's low. I think it's still a real possibility. This, it was a nice bounce, but in the scheme of it, it's not much different to the bounce we saw the week before. So yeah, this is still fragile. Coming over to the Nasdaq, prices broke down from their 6 weeks range. So see this trading range, 6 weeks of trading to the lower side of the moving averages, and prices broke down from that on Thursday. Attracted some follow through selling on Friday to take things down to a new low. And when we look at Monday's bounce, so look at Monday's rally, this last bar, well, it stopped just below resistance from the previous range. So it got back to this blue horizontal line we have, which is where all the previous lows were, got back to there, and then attracted some selling into the close, and prices closed down near the day's low. So the price action that we have, it still leaves the Nasdaq vulnerable. It really needs to rally back within the old range to start to disengage some of that near-term risk. And then we go over and we have a look at the Magnificent Seven, the ETF, which tracks the big seven tech stocks. And this is probably the most vulnerable of the three in terms of its price structure. There's this long series of lower lows, and of course the lower highs, and prices have been consolidating below declining moving averages, and the moving averages here have actually crossed and turned to the downside. So it's a pretty ordinary looking structure. On Thursday, the Magnificent Seven broke down from this trading range they'd been in for. That's probably about 4 or 5 weeks. Broke lower on Thursday, followed through selling on Friday. This isn't the price structure of a stock I'd want to own. It's a sort of price action that I'd be looking to get out of, certainly not get into. For me, it remains an ongoing process of reducing risk as stops are triggered, but at the same time continuing to hold on to stocks that haven't given me cause to sell. I've got plenty of stocks which haven't given cause to sell either. As I said earlier, it can feel. We can sometimes get to the point where we just say, look, just sell everything, just get me out. But unless there's a reason to sell, it's like we don't know. Is this going to really continue to unravel, or will it like make a new low and then start to turn? That's where it's following. It's all about following the plan, not trying to just second guess what's going to happen next. At this stage, this is not a sell everything event. Well, at least not for me. As I said last week, be prepared for volatility, follow your plan, don't let other people's fear to become yours. And while I know it's tough, try to keep it unemotional and systematic and process orientated, how you approach these situations.
Fantastic, Jace. Some good life lessons there. Don't let anyone else's emotion become yours. Let's have a look at that Hong Kong and China market. Very relevant.
And it's hard to do when when you've got a lot of people panicking. It's hard not to get swept up. That's what a panic is. It's like it's crowd panic. It's like it feeds upon itself, and it's hard not to be impacted. Even if you stay rational yourself, your stops are still going to get triggered by panic. But I think the best we can do is to have a plan and follow it, rather than just going, well, everyone else is panicking, so I'll panic too. Doesn't mean we don't get losses, but at least we keep some control over our own situation.
Well, this Kirby's just mentioned the 200 EMA has also been broken by the US indexes, so obviously that's a major one that a lot of people look at, right? But yeah, it's all up to your. It all depends on your plan, right? So and what you're following. So.
The 200-day moving average is not like a magic line that as soon as it's crossed, prices are going to plummet. You can get brief tests of and around of a key moving averages, and prices then stabilize and move higher. But if we were to get like a clear break and you get a consolidation below it, and then you get a secondary break, then you're really looking at like a larger bear market. But we don't have that price action yet. We've got a couple of days below it. So more needs to happen before you can say that means it's like a longer bearish phase coming on. Looking at the Hang Seng, this is broken down. This had been holding up fairly well over the last few weeks. We've been talking about how it come below the moving averages, but it was still holding above this support from these previous lows from last year. That all changed yesterday, broke below. It's opening today. There's a bit of a bounce today, but we can now say there's a series of lower lows, lower highs, moving averages are crossing. The last consolidation was beneath the moving averages and breaking lower. It's a market I'd be exiting if I was in it. Look, and when I say that, it depends on people's timeframes. If someone's a long-term ETF holder, they may be doing something different. But for me, from a more medium-term strategic perspective, it's a sort of structure I'd be de-risking into. And then over in the Chinese market, well, again, it's like it's rallied into the moving averages. It was a nice rally, and I think I might have said the key would be like, let's see how the next pullback looks like. Does it hold onto its gains? It hasn't been holding onto those gains. It's giving them all back, and it's on the cusp of making a new low. Yeah, look, this is a market I'd be backing away from as well.
All right. Okay. There's been a couple of questions in there, and I think it's an obvious one to just quickly go over. Jace, gold and oil. If we can have a look at those in general, that'd be great.
Yeah, look, these are two I talk about in depth in my strategy sessions on Friday, and so I just briefly pull them up. It's gold's pullback. This is something we've discussed quite a bit. It's like often you get the initial sell off, you get the initial rebound. It's like when you drop you drop a tennis ball, you drop it, it bounces, it loses momentum before coming back to the dropping point, and then it falls again and retests the low. That's what we're seeing in gold. And you look at it on a weekly basis, it's only now just coming back to the 50-week moving average. It was so stretched that this pullback, it's like it hasn't been a huge surprise, I think, if we've been following this price action and following how stretched it was. Looking at it now, it's like I think it's a case of again deciding like is someone long term? Are they medium term? If they're medium term, if they've got positions which are now starting to break down, well, maybe it's a case of exiting those positions. If they're a long term ETF holder, well, maybe it's a case of riding it out like riding out other corrections of the past. Like gold's been in a big long term trend since really, you can say it's been a long term trend since back in 2000 thereabouts. But you've had to ride through some big pullbacks along the way. How big this is going to be, we don't know, but it could be. I don't think we're going to be seeing new highs in gold for many months. At best, I think this is a multi-month consolidation, which moves sideways along the moving averages, or the more bearish possibility would be that it does actually pull back below the 100-week moving average. So it depends. Are you long term? Are you medium term? If you're medium term, I think it's probably continuing to maybe de-risk into the some of those gold stocks which are pulling back. Longer term, I've got core longer term holdings. I'm not planning on selling, which I've held for way back when. But yeah, look, the bull market in gold is certainly on hold for I think at least many months. Oil was the other one, and like we've talked about how you could see the the building price action in oil in February. Then there was like the big breakout. I spoke about Woodside as being probably the pick of the local energy orientated stocks. But look, it's not a sector I'd be looking to buy anything into now, because it's like big trends in oil. The big trends in oil aren't conflict related; they're demand related. Conflict spikes tend not to turn into long-term bull markets. So this is the trouble with oil now. We've got there's bullish momentum there, but for it to sustain, the crisis has to get much worse to just keep driving prices higher, or there's got to be a demand reason to keep pushing prices. So I think it's a hard one. It's not an area I'd be looking to do a lot of buying in at the moment. I've got a stake in Woodside. I'm happy to let that run, but I'd just be as we saw last night. One comment and the price can quickly drop. It's it's an area I think we should expect volatility, and that volatility could be either side.
All right, fantastic. So before we get on to some tickers, Jace, there is a lot of talk, obviously, at the moment with prices are down across the board. We kind of have, I know your sentiment around, trying to get in, picking lows, and I guess for those that are dollar cost averaging, might be on the show, that might be into that, and getting in on the, as the price goes down. What are your thoughts around all that in general, Jace?
No problem with dollar cost averaging if that's a strategy someone uses. If someone buys a bit of ASX 200 ETF every month or whatever it may be, sure, continue doing it. That's something which is done in good times and bad times and quiet times. That's a completely viable process. In terms of just going, okay, I think this has fallen enough. I'm going to buy. It's look. Sometimes you get the low. Often you probably don't. I'd rather wait for some sort of price action to suggest maybe there's a turn coming, and that means I won't get the low because I'm going to react to something that happens, like a strong up day on heavy volume. Then I might go, okay, well I might buy into that and I could have an exit below the recent low. I prefer to play it like that rather than just wading in. Look, there are going to be people who like their fundamentals who go something's now cheap, but that's not my game. I don't do that. Doesn't mean it's wrong. It's just not my area. My preference now is to let things settle down. I'm going to exit what I need to exit, hold what I can, and when things do ultimately settle down, and they will ultimately settle down, new opportunities will emerge. Prices will move back above moving averages will turn higher, we'll get breakouts, we'll get new momentum, and that's where new opportunities come from. It happens every time there's a downturn of some magnitude. I can't see why now will be different, but for me it's about waiting for the price action rather than just going, okay, it feels like it's down enough, I'll buy now.
Okay, I think that's a great response. Thanks, Jace. I'm just reviewing any previous chats from our failed attempts at getting on the show, and I think we should be okay now to resume. Let's start off with our first stock here. Can you please review WBC? Yes, so banking stock. So Westpac, I'm assuming. What's that?
Yeah. Well, it's been interesting because the banks have been holding up really well. The banks have not broken down. Like there's the financials index. That's the ASX 200 financials index. Yeah, if we just call that up on its own, we didn't know anything that was happening everywhere else. Would say, look, that uptrend's still intact. It's had a run. It's pulled back to the moving averages. Everything looks good. You wouldn't know there was turmoil elsewhere. Same with Westpac. It's like it's just rallied to a new high, pulling back to the averages. Trends in place. If I was holding Westpac, like this is what I was getting at earlier, what I was saying earlier. It's like I don't want to sell stocks I don't ever need to sell. So if I look at my portfolio and say where yesterday when there was a whole lot of selling going on, it's like, well, I don't want to then go, okay, everyone's selling, I better hit the sell button, sell all my stocks, just get me out. And I sell a stock like Westpac. And there's no reason here to sell it. it's above its 100-day moving average. Now that's not to say it can't turn down, it can't break lower, that things can't go amiss. But at the moment, that's not the case. At the moment, it remains an upward trend. I would continue holding on to it. Yeah. So yeah, if I'm following a plan with Westpac, I've got a trailing stop, which would still be comfortably above. And for me, this remains a hold.
All right, fantastic. Thanks. The next one is from Max, and we're looking at the QSML ETF. Would you be worry about selling it or buy more at a discounted price?
Yeah, I'd leave it alone at the moment because I want to see signs of a low forming. Like there are aspects of the US market which we went through, like the Nasdaq and the S&P and the Magnificent Seven, that were there's still clear vulnerabilities. So I don't want to come in and buy. And like there's been there's sentiment is becoming is being beaten up with this sell off, but it's not like extreme bearishness at the moment with some of the sentiment gauges which I see. Uh, so, like, could there be another flush to the downside? It certainly could. So, I wouldn't be buying at this point. Like, could the structure change? Could this be part of now a consolidation below the averages, which turns lower? So for me, it's not a buy. But for someone who might be a long term holder and just likes to accumulate on dips of 5 to 10%, well, maybe they've got a different approach. So there's not one way to do everything. It depends on your situation. It depends on how you're approaching the particular stock. So for me, it's a wait for now. But look, in the fullness of time, we could find that it does base somewhere in this vicinity, and we look at it in 6 to 12 months, and prices are at new high. It looks like a tremendous entry point. But there's always risk when you're stepping up to say, yep, I'll take markets falling. I'm going to take a bit of that because some of these pullbacks turn into larger bear markets. Most don't, but some do, and you can't be sure at this point when this one's going to base and turn higher.
Good, thank you. Next one's from Langle. Let's have a look at XRO.
I'd really be leaving this alone, and that would have been the case for some time. It's in a downtrend. It's well below its averages. It's like it's tried to rally recently. It's been sold again. Like it's yeah. It's just like there's this just looks all risk to me. It doesn't look like opportunity. I'd rather get in later and pay a higher price, but wait until prices are above moving averages, which start to turn higher. But that's all going to take time. For the moment, yeah, this would be a stock which wouldn't even be on my radar yet because it's not close to setting up for me what would be a viable opportunity.
All right, thanks for that, Jace. We'll look at one of the oil companies in America, the big ones. Let's look at Chevron, which is CVX, I think. And that's the opposite to this chart.
Yeah, it is, and it's yeah. Look, I'd be happy to keep holding if I were in this. Um, yeah, look, there was probably got a nice breakout for it back around mid January. Uh, let profits run, see where they go. Trailing stop back below the 100-day moving average, and yeah, just see where this goes. Look, it's the same approach I'm using with Woodside at the moment, in that we had a breakout from a big trading range. There's a nice momentum play in motion. Let it run, see where it goes. If the oil price turns and comes back, well, maybe it doesn't turn into a mega trend, but we don't know. Maybe it does turn into a long lasting trend. So I'd certainly be holding it. I wouldn't be racing to buy it at this point because it's up at its highs, and it's not like this felt like a nice entry point back in mid January. But now we're here in mid March. It seems like it's already had a run. I'm happy to stay on that run, but I don't want to step up and now start to buy it.
Okay, thank you. Next one's from Lloyd, SGLLV.
That's a different one I've never seen. Yeah, there was a nice trend there, consolidated around the averages, but now it did start breaking down in early February. Um, and if yeah, even with the wide trailing stop, it'd be triggering that wide trailing stop now as well. So had I been on this, it had been a nice trend. So from when it first started to break higher, we can actually see there's some moving averages crossing. Here's like a breakout point around $6.80 thereabouts. A wide trailing stop could have seen off all these pullbacks on the chart. Could have seen that off, but it wouldn't see this off. So I'd just by eye, I'd say a wide trailing stop would have ended around 14.30. So that there'd be 100 and something percent gain, and I'd be then closing it down. Uh, like maybe it bases here and then moves higher again, but that's not my approach. If someone's like a longer term holder and they like the industry and they like the fundamentals of it, maybe they've got a different way of doing it, a different approach to holding it. But that's how I do it. I would have taken that big momentum or big trending phase, and moved it on after it came back to a trailing stop. I wouldn't be buying it here. It's below the moving averages, so whilst it's below the averages, I'd stand to the side. If it makes it way back above the averages, then happy to look at it then. But for now, it's that big trend that took it up has been severed, and it's probably going to take time to consolidate before we can look at the possibility of that trend re-engaging.
Okay, thank you for that. Next one's from Mick, 4DX, please.
It's still holding. Trend remains intact. Hasn't it's interesting that it hasn't sold off with the rest of the market. It's actually made some headway in the last 3 weeks, whilst most stocks have been sold hard. If I was holding, I'd keep holding it. I'm apprehensive to buy anything at this point in time. But if this were in my portfolio, I'd be holding it because I don't have a reason to sell it. It hasn't broken down, so there's no trigger for a sale. Stop below that back below the 100-day moving average, and let's see if it can keep at the least if it can hold its ground in the current environment, and then maybe push forward when things stabilise.
All right, thank you for that, Jace. I think we've pretty much gone through most of the tickers, and obviously I've sort of cut it short today just in lieu of the time we spent trying to log on this morning. But let's have a look at finally a couple that you mentioned, Jace, if that's okay, and it's probably around the oils as well. Oil play is Yancoal, I think, is one, and then Woodside as well.
Yan keeps pushing higher. It's broken out of this big multi-year range. Often when you get these breakouts from ranges, prices then pause and they pull back and they consolidate maybe for a few months and then have another run. I'd be happy hanging into this, holding on to this one. Wouldn't be a buy here, not after such a big run and getting stretched above the moving averages after breaking from a range, because there's also going to be volatility around the situation around energy and what happens to the oil price. But happy to hold it, but I wouldn't buy it because, what if we get a bit of a sideways period or a pullback, and then from there prices could start rallying. All sorts of ways this could play out. That may not be it, but often we do get these pullbacks to near the breakout point after a strong rally. So hesitant to buy it, happy to hold it. And the same goes for Woodside, which I've said I do actually hold it. I talked about on the strategy sessions back in around, would have been the 20th of February, just after the breakout. Prices broke higher. That was the entry point, and it's been a nice run since. But I don't want to be buying it up at these elevated levels when it's so stretched above the 50-day moving average. It's a sort of stock which could pause, consolidate, could pull back. It could spike higher, in which case I'm already positioned. But from a risk reward perspective, I don't think this is a terrific entry point just at current levels.
All right, thank you. We'll finish off, Jace, at with a comment here from Kirby, if that's okay. It's good to have a look at because we don't really look at oscillators a lot, but he's also mentioned that the All Ordinaries dipped into the oversold territory on the RSI, which is a relatively rare occurrence, and is usually close to, but not always to the bottom, right? So obviously not always, but it's maybe something to look at.
Yeah. Yeah, look, that's interesting. But look, be careful with RSIs because RSIs can stay oversold or overbought for a while. Particularly overbought, they can stay overbought for quite a while. Like someone might have seen it ticking into overbought territory back in June last year. But as you can see, there was quite a bit more rally, so prices can stay overbought for some time. With like it's just ticked into the oversold area now. But like you look at this experience back in March last year, and that was things still had further to go. There was a bounce, but there was another sell off, and there was another prices got out of the oversold zone, but then came back into it. Um, so just it's probably the way I'd use these indicators is let them come down, then wait for them to turn back up, rather than just letting them dip in because they could keep dipping into it. So wait for the turn. Like if you would have done that on this occasion, so wait for the turn. It wasn't the turn, but you're going into some momentum, and then you might have an exit strategy. If it fails, get out of it and then have another go. Then it turns, and then you get an entry point, and this time it does continue. So that's probably the way I do it. You can do the same thing over here from November. So it got below, wait till it turns back up. So somewhere up here, rather than preempting a final low, wait for the indicator to turn, and I think that works. I don't like it so much for buying. Oh, sorry, don't like it so much on the upside, like looking for reasons to sell. I'd rather just stay with the trend and let let the market stay overbought for a while. But that sort of approach can work well in for looking for entry points when markets are at downside extremes.
Yeah, it's a good point actually, and obviously this takes me back a bit because now I'm looking and picking out and when you look back in retrospect, you can see the divergences happening at those either lows or the peaks, right? So you could probably see it that at the most recent low back in 2025 May and June, you can see there's bullish divergence there, but it's always in retrospect, and it's one of those things that I've sort of learnt not to use now oscillators because you always see the divergence in retrospect, don't you, Jason?
Yeah, divergence is tricky. Divergence is tricky. As you say, Rog, you can see it clearly when we look back in the past,
Mm.
but it's harder at present time because what appears to be divergence can just simply disappear as as in real time as new price action occurs. So, like here's another nice divergence over here from 2023, which marked quite an important low. Uh, by all means, I'd look at it, but I wouldn't go and say I'm betting everything on it. It's one factor to take into account, but I'd want to wait for that upward momentum. As I want the price action moving in my direction, not trying to preempt a low. So with this oversold RSI at the moment, there's nothing to say it can't have another dip to the downside should the market go and have another. sharp, like flush to the downside. That may not happen, but it could. So yeah, just keep that in mind with oscillators. They can
Yeah.
always get more extreme.
Yep, for sure. All right. Okay. I think we will call it a day for this week. Apologies for the delays in getting on at the start of the show. For everyone that's still watching at the moment, we are having a 1 week break next week, being the start of some school holidays. So we are going to have a 1 week break, and we will be back on the 7th of April, I believe. Yep, 7th of April. So we hope to see you then. Once again, if you've enjoyed the show, we'd appreciate your like and your comment. And if you haven't subscribed yet, then do subscribe to the channel, because it's probably the easiest way to get a reminder of the show at 12 o'clock on a Tuesday. But if obviously we won't be here next week, so we'll see you back on the 7th. Thanks, Jace, for another interesting show, and hopefully we'll come back to maybe some more bullish action, but we just don't know right now, do we?
Yeah, no, it's like, yeah, hope for the best, but have your plan in place so we're ready for no matter what happens.
Yep.
But look, it's been good, Rog. Yeah, thanks for coming on and hosting the show, and viewers for joining us. It's been good. We'll look forward to seeing you in a couple of weeks.
Yeah. Thank you very much, viewers. Thanks for your patience, and we will see you in a couple of weeks' time. And have a great week ahead. Bye bye.